Welcome to CoreLogic's update on the housing market for May 2018. Nationally, dwelling values continued a downwards trend last month, the seventh consecutive month-on-month decline since the national index peaked back in September last year. While the national market has slid into reverse, many of the trends we've been following over the past 5 years have also reversed. For example, regional housing markets are now outperforming the capital cities. Also, the unit sector has taken over from houses as the best performed, at least in Sydney and Melbourne, where affordability constraints are the highest. Another change has been that lower priced end of the marketplace is now showing better conditions than higher priced properties, which is likely the result of more first home buyers, as well as affordability barriers preventing more activity across the higher price points. These trends aren't always uniform across each of the capital cities and regional markets. Generally, we're seeing growth conditions showing a mild pickup across the regional markets while capital city markets ease. CoreLogic indices show the combined regional markets recorded a 2.4% rise in dwelling values over the past 12 months, while capital city values were down by 0.3%. On a rolling quarterly basis, the performance gap is getting wider, driven by strong conditions across the major centres within close proximity to Sydney and Melbourne, as well as more regional demand flowing into the coastal and lifestyle markets. Additionally, regions linked with the mining sector are showing signs of bottoming out, creating less drag on the headline growth rates across the mining states. Looking at the performance based on housing types, units are now broadly outperforming houses, either by showing higher capital gains or more resilience to falling prices. While this is the case at a national level, it's really Sydney and Melbourne where the pricing gap between houses and units, as well as a surge in price-sensitive first home buyers, are supporting growth in unit values over house values. Every other capital city has seen house values outperform the unit market over the past 12 months. While the most expensive properties are showing the weakest conditions across most cities, in Perth and Canberra, it's actually the most affordable end of the marketplace that's underperformed relative to other broad value-based segments. The falls in home values are very much concentrated within the two largest cities, Sydney and Melbourne, where dwelling values had previously been rising the quickest. Since peaking in July last year, Sydney home values are down a cumulative 4.3% and Melbourne values have fallen by 1.1%. These are also the cities where investment activity has been most concentrated, highlighting that tighter credit conditions for investors has played a big role in slowing down the market. While Sydney and Melbourne are experiencing the most substantial and consistent falls, most of the other capital cities have also seen the rate of capital gains easing over the year to date, or they've actually seen subtle falls. Over the first 4 months of 2018, dwelling values have nudged lower across Brisbane, Adelaide and Perth, while Darwin and Canberra have recorded only subtle gains. The only market showing a considerably higher rate of growth is Hobart, where values are 4.6% higher over the first 4 months of the year. As housing market conditions generally ease, other indicators have also softened, including the number of settled sales, auction clearance rates, and credit flows. Additionally, advertised stock levels have shown a substantial rise in Sydney and to a lesser extent in Melbourne. Nationally, settled sales are down by 5.7% year on year. Although there will be some upwards revisions as off-the-plan unit sales move through to settlement, it's clear that there are fewer buyers active in the market. Sydney has seen the largest year-on-year fall in settled sales activity, with volumes down 12.3% relative to the previous 12-month period. Clearance rates have generally been holding around the mid-60% range through most of 2018. More recently, though, clearance rates have been trending lower, with the final week of April seeing Sydney's clearance rate dip to 56% and Melbourne clearance rates also on a clear downwards trajectory. The lower clearance rates highlight that selling conditions have weakened over the past month. Unsurprisingly, housing credit, which is a key indicator of market activity, has remained weak. The Reserve Bank figures show annual growth in housing credit has reduced to just 6.1% per annum, the slowest rate of growth since March 2014. Weaker credit growth is a result of less investment activity, with annual growth in investment lending tracking at just 2.5%, compared with owner-occupier credit, which is up 8.1% over the past 12 months. The slowdown in investment has been ongoing since the first round of macroprudential changes in December 2014. Although APRA has recently announced they will be lifting the 10% limit on investment credit growth for eligible banks on July 1st, we aren't expecting there to be a rebound in investment lending due to overall tighter credit policies with more focus on debt serviceability, on restrictions on interest-only lending, and a general requirement for keeping low deposit lending to a minimum. The Brisbane housing market has remained relatively flat over the first 4 months of the year. Dwelling values are down by 0.1% so far this year, in essence a flat result. The Brisbane unit market has been under a lot of focus due to higher supply levels across key inner city suburbs, and overall Brisbane unit values remain almost 12% lower than what they were 10 years ago. Despite the long-run weakness, Brisbane unit values have edged higher over the first 4 months of the year, rising by 0.1%. While it's probably too early to signal the local unit market has turned a corner, it's important to note that unit construction activity peaked almost 2 years ago, and new supply additions are now tapering as population growth starts to pick up. Overall, the weaker conditions across the capital cities are likely to be mostly attributable to tighter credit conditions, particularly for investors who have been faced with mortgage rate premiums, restrictions on interest-only lending, and more recently, stricter servicing requirements. To highlight the slowdown in investment, annual growth in investor mortgages has fallen to just 2.5%, well below the recent peak of almost 11% growth per annum in the early 2015s, which was just after the first round of macroprudential tightening. Of course, other factors are at play as well in dampening housing market conditions. Despite lower prices, housing affordability remains a pressing issue, especially in Sydney and to a lesser extent in Melbourne. Our latest dwelling price to income ratios put Sydney dwelling prices 9.3 times higher than gross household incomes, and Melbourne prices are 8 times higher than household incomes. Other capital cities are showing much lower ratios, highlighting that housing prices haven't outpaced income growth as much. In fact, on this measure, housing affordability has improved substantially across Darwin and Perth as dwelling prices have trended lower and incomes have posted a modest rise. The outlook for the housing market will be largely dependent on how credit policies play out with regards to banking appetite for lending. Although APRA has announced it will lift the first macroprudential policy, that's a 10% speed limit on investment credit growth, we aren't expecting this to have a material impact on credit availability. Lenders are likely to be focusing more on overall debt serviceability, as well as validating borrower expenses and incomes, minimising high debt-to-income loans, as well as low deposit loans, all of which will keep a lid on credit growth, especially for investors who still face mortgage rate premiums and less opportunity to secure a loan on interest-only terms. Add to this the uncertainty of a federal election, which will be held sometime over the next 12 months, no doubt there will be further debate around taxation policies as they relate to housing. Changes in negative gearing and capital gains tax policies could pose further headwinds for the housing market should they be introduced. It sure is interesting times across the housing market and the economy. If you'd like to stay up to date with the latest trends in the housing market, you'll find plenty of research content at www.corelogic.com.au.